miss out on all that profit.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Walter, when do you think people should move their stop loss to break even, or if they should or not?
Okay, so all right. So if you're trying to avoid the psychological pain of drawdowns, then you can move it quickly. If you're trading someone else's money and you have concern, like there are like hard levels that you don't want to hit, like drawdowns, then that's something to consider. So if the goal, and some people would argue the goal should always be this, but if the goal is to avoid drawdowns, then moving to break even and all the rules that go with that and how quickly and all that, that's great, right? But, and I know traders that are really quick to move to break even. However, the problem with moving to break even quickly, obviously, is that what happens is, and this has happened to me, like I've got this new account that, again, the goal is to keep the trades, keep the drawdowns to a minimum. And so, and I, that's fine. That's what I signed up for, whatever. But so I've been using a really quick break even rule, move to break even. So the problem with that is that there's always going to be ebbs and flows in the market. So when you're in a position, it's always going to go for you and against you, right? And you'll start to like try and figure out what are the patterns of this, why is this happening to me, and all that sort of stuff, right? Mm-hmm. And that's fine too if you want to use that. But the issue with moving to break even quickly, it's sort of like when you use a buy stop for a buy trade or a sell stop for a sell trade. You're letting the market tell you, yes, you're correct, I want to go this way. And Mr. Market says, let's go this way. And so you get clicked in, right? Whether it's a sell or a buy, doesn't matter. When you use a stop order and it's above a high or a low, you're basically saying the market needs to make a new high or new low before I decide to get in this trade. So the market's pushing you that way. The problem with moving to break even, though, is a lot of times I've noticed, and if you look at data, you often see this, that you will reduce your overall profitability. Mm-hmm. Okay. And if you think about it, it makes sense, because what happens is you're not allowing those trades that click you in and then go a little bit in your favor and then come back down and go a little bit against you and then end up going where you want it, where your target is, or your trailing exit gets you out or whatever, right? Mm-hmm. So that's the issue with that. So this is kind of the trade-off. And like most things in life, it's a trade-off. So what you can do is you can really pump up your win rate if you have a quick move to break even rule. However, that's because you have this big chunk of trades now called break even trades that move in. You have winners, you have losers, and then you have break even trades. And what's happening is you're just increasing the break even trades. And some of those trades would have been winners and some of those trades would have been losers, right? Mm-hmm. And so what you're banking on is that you're eliminating more terrible losers than you are eventual winners, right? Mm-hmm. And so that's what it comes down to. Now I've done studies, and you'll see that typically, a break-even rule will reduce overall profitability. But the problem with that is it also can reduce your drawdowns. Mm-hmm. So it really kind of depends on what's the main goal. And the stock guys and the futures guys that do their studies, they'll show you too how, like, without a stop loss, you get the highest profitability, right? Mm-hmm. Well, yeah, sure. I mean, okay. If I'm not going to let the market stop me out, I'm going to have a lot of profit, right? Like I'm not going to get stopped out. But the issue with that, of course, is obviously the big losers, because they'll say I have a mental stop. The price goes here, I'm going to get out, that sort of thing. That's all fine until the market really rips against you, and then you're like, oh, my mental stop was over here, and the market's now like gapped below that. What am I going to do? So it's a tricky thing, but it can definitely work. I know lots of traders. A good trader friend of mine, he uses it really like exclusively, and he has his win rate in the high 80s, and all that. And so that's all great. And so that can unlock some really aggressive risk management for you and all that. But the overall, if you were just to let it ride, typically you're better off. I mean, you're going to have deeper drawdowns, right? So it's a trade-off. So what are your thoughts on that?
Yeah, I think that's the hardest thing to do, right? I think FOMO really factors in this case, because when you let it run and then it goes all the way back and you get stopped out, then you're like, oh, I missed out on all that profit. And then the next one, you tighten it up, and then the next trade would have hit your take profit. So I think it's really all about like, yeah, testing everything out and figuring out what works for you and sticking to it. Because like you said, there are going to be drawdowns on both sides. There are going to be benefits on both sides. So I think you really have to figure out what's best, and you really have to and get that ingrained into your brain. Like understand that, okay, I'm not going to get the big winners if I move to break even quickly, or if I'm not going to move to break even quickly, then I'm going to have to tolerate more losers, and then I'll hit those few big winners here and there. So I think that's what it's all about, and not flipping back and forth between the two methods.
Yeah, exactly. Yeah. Exactly. Yeah, because you can talk yourself out of it and back into it and all that sort of
That's
stuff.
really
Right?
easy to do. Yeah.
Oh yeah, totally. Like anything in trading. I will say that there was an interesting approach one of my trader friends, Colin, used. And I thought it was fascinating because he did have a break-even rule on a system that he traded where it was kind of always in the market.
Mm-hmm.
But what he waited for was he actually moved to break even really, really late. Because it was an always in the market system, you would have a counter signal to get you out of the last trade and into the opposite, right? So you're always short or long. And so what was interesting was he'd take the signal, he'd expect the market to kind of go in his direction, and then eventually there'd be a major pullback against him. He would wait for that major pullback to sort of peak and then start going back in his direction before he would move to break even. So and if you're looking at like a 4-hour chart or something and you're doing this, you might have a situation where you have a 200 pip stop or 150 pip stop. Let's say 150 pip stop, okay? And then you would see the market go like 200 pips in your favor, maybe 250 pips in your favor. Then it come back and goes, and you're negative 75, right? And then it goes again in your favor, and now you're up 320, let's say, or 340.
Mm-hmm.
And then like now he moves to break even. You actually have to sit through a pretty horrible pullback. And he was always banking on that happening because he knew that the market moves in waves, right?
Mm-hmm.
And so I just thought that was fascinating because most people wouldn't be patient enough for that. And it made sense because he was in an always in the market system. But I just saw that was a really interesting thing that people could possibly test if you like this idea of moving to break even, right?
Mm-hmm.
It's kind of a compromise because, he's still going to get stopped out. It wasn't like his break even was to stop him from getting stopped out. It was more like, it was just like, okay, the trade's going now, things are taking off. Let's just make sure that this is a winner. It wasn't like, I got to protect my, my risk capital. It was more like, okay, we're in a winner now. And then it was more like a terrible, huge move that he was trying to, he didn't want like, you know what I mean? Like something terrible to stop him out of the trade. That's all. Yeah.
Yeah. I mean, that makes sense because generally you'll get stopped out, or it'll get close to your stop loss, and then people get nervous and they get out, and then that's when the thing takes off, right? So yeah, that makes a lot of sense. Yeah.
Yeah, exactly. Yeah. That's right.
All right. Thanks, Walter.
Thank you.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.